welcome back. Welcome to 2022 and to our first episode in this new year. It's episode 26, and I'm excited to kick off the series again. I hope you all had a good start. I think, kept all busy by the volatility and the events on the power and gas markets. And once in a while, we think it's important to step back a little bit and look on the structural changes that happen in the more long-term effects we will see, determining the market in its development. That's why we invited Xavier Veillard to us. He's a partner with McKinsey Company and leads there the French energy practice and all the activities around commodity trading globally. So he's the expert for today, and I'm really glad that he's back with us on this episode. And without further introduction, I'm handing over Javier. Great to have you, and please start.
Thank you, Jens. Thank you again for the invitation, and very happy to be here with the group to share our thoughts and perspective. And really at the end, hope we can have a few questions and turn this into a discussion. So normally everyone should be seeing my screen. I think, let me just directly go on the next page, if that works well, yeah. The idea for today is to go through 5 trends. As we go through the trends on the following pages, I will not do the summary here. And just to conclude on what these trends mean in terms of price development, price outlook. And the trends are really focused on medium to long term. So obviously I will not be the one helping you predict what will happen to the markets for the next few weeks, few months, unfortunately. So let me start with the first one. I think no surprise to everyone, we anticipate a structural growth in power consumptions as we go forward. I think what's interesting is that the latest thing that came in over the last 24 months is the share that will be driven by hydrogen. So all the green hydrogen projects that have been announced and that are in the pipeline will actually eat quite a lot of a chunk of the incremental power production that will come, more precisely the green power production. And you can see on this chart here that this black bar at the top, which is the anticipated growth in power consumption from hydrogen, is basically exploding as we speak, and is going to represent 230 terawatt hour, at least we think, by 2035. So that's an important new variable in the system that probably 24 months ago we didn't have on our radar, we didn't even have in our models. I think the next thing that is important is, where's this growth of power coming from? And so obviously you have growth that is coming from GDP, you have growth that is coming from electrification and substitution in transport, in the industry, in heating and buildings. But also it's important to say that there's still a lot of efficiency gain and reserve in the system. So in our model, when we look on a country per country basis, we still see a big reservoir for energy efficiency gains, which will translate into the growth that we share. And often people sometimes think that the fundamental growth drivers should lead to a higher number. But when you take into account the efficiency gains that you anticipate, along with the supporting scheme, for example, white certificates in countries like Italy, like Poland, like France, and so forth, actually there is a reduction also in energy consumptions that we anticipate is non-negligible. And you can see here, it's around 640 terawatt hour for Europe. No surprise to everyone, the coal phase out will lead to a significant drop in dispatchable power. So what is shown on this page is essentially just the outlook, taking into account all the coal phase out plans of the different countries. And obviously when you look at the capacity today versus the capacity in 10 years from now or 10, 15 years from now, we get roughly over 70% of the capacity out. So that's on the coal side. And when you go on the nuclear side, even though, okay, now we have some we have some uncertainty on what some countries will do with their future nuclear plants, for example, as it's the case in France, still we have a number of countries which have clearly said what they will do in terms of drop of dispatchable nuclear power, like in Belgium, like in Germany, like in Spain. And so it is anticipated that obviously there will be this drop in nuclear power. And so when you take this into account and you look at the capacity outlook, we leverage a model using Plexos to look at all the capacity output that we see in the system. What you can see basically is on top of the growth that you have for renewable energy that you see here, so solar, wind, onshore, offshore, basically, I mean, the intermittent energy share, That's increasing by about 600 terawatt hours. So on top of that, what you see on this chart is that the dispatchable capacity at the bottom is a bit flat at around 540 gigawatts in terms of capacity. And if I were to go and double click on that on the next page, what you see basically here is again this growth of capacity on the renewable side, on the intermittent share of the renewable side. So what you see here is again this growth of 600 gigawatt. Sorry, I mentioned the wrong minute before. And what's important to see is that this growth will need to face a number of headwinds. Because when you look out there to roll out 600 gigawatt of capacity in the market, you need to ensure that the approval process doesn't take more than 2, 3, 4 years. And we know that in some countries, for some projects, the approval process and the time to market for some of the projects is taking longer timelines, especially when you take into account everything. Land approval right, consultation process, local community consultation, TSO connection process, license process, and so forth. And what you see also is that in the market, there are more and more opposition for some of the renewable projects. Onshore wind, for example, in some countries, we know that the eligible land for onshore wind, has been significantly reduced. Or in some countries, they're looking to limit it extensively. And so when you take this into account, what's important is that this additional capacity that we need in our model, and essentially that we anticipate can be built, will probably face a number of headwinds that we should take into account in a maybe more conservative scenario. And the other thing now is if we look at the dispatchable power that you see on this chart, basically we have a drop of dispatchable power. Again, we know because as shown on the previous pages, we have coal, lignite, and nuclear, which are reducing in volumes. And so what you see that's interesting on the chart on the left is that you have the total capacity of dispatchable power. And then what you see is that, that as this capacity drops, the only thing really that is increasing on this chart is it's pretty much a small share of biomass and then a small share of hydro. Okay, and so the question is, what can be done to fill the gap in terms of dispatchable power? And so what we put and what we see in our model is more gas and more batteries. And the thing is that gas is more of a story for this decade, and battery is more of a story for the end of this decade and the next decade from 2030, because of consideration around cost and around all the ancillary services that need to be structured around what the battery can offer. And so when you see in the market, you obviously have a lot of gas projects that are in the pipeline. Some of them are in advanced development or have reached FID. Some of them are already in construction, but some of them, it's what we anticipate could be added or is more in the planning stage. So there's still a lot of uncertainty on some of this additional gas capacity. And when you see the chart on the right, in our model, we anticipate that there will be less added capacity than all the projects announced today, which is the waterfall that you see. So we have a bit of a more conservative view versus all the projects that are in the pipeline. I will skip this page, but there is a lot of question around all the capacity mechanisms that could be put in place in countries which don't have them to support this gas capacity rollout. Another element that is important is when we look at the market evolution is the development of the interconnection, between the different markets and the ability, therefore, to leverage capacity of one country or the other. So what we show here is the development of the interconnections across Europe based on public announcements. And what you see, obviously, is that we evolve towards a more and more integrated and interconnected European power markets. And what's interesting is that if we zoom on Germany, which will be the next page, you see basically basically that Germany will be, and is already, but will be really at the center of the interconnection flows in Europe. And so this market, which is already the largest power market in Europe, as it's more interconnected to its neighbors. And you see here what we anticipate in our model, and this is just a simulation of the flows that could happen in Germany in 2030. And so you see the level of contribution by the different countries. Obviously, in our model in 2030, it's a net import scenario. But that can always change depending on what capacity build-out announcements are mentioned. You can see large contributions from France and from Denmark. But I think most importantly, what you see is that the level of interconnection will ramp up significantly. And that you see on the chart between the number of the current capacity at the moment and what we anticipate at a later stage. And so it's really growing with all the neighbors, and it will basically help again put Germany at the center of the power markets and being to be a bit less liquid. What we wanted to highlight also on the page here is the growth in intraday short-term trade that we have in the European market today. And what you can see on this page is, and we will soon reflect it for 2021, is we're all facing a significant growth in the volume of short-term intraday transaction as we move to more granular short-term slots. And it raises significant implication for some of the players who are operating in these markets, mostly in terms of automation, machine learning, AI type of models, which can leverage all the intelligence possible to deploy the best dispatch programs to minimize imbalances cost, or basically optimize what they can do on the dispatch side during the day, optimize between what they put on ancillary services, day-ahead auctions as well. And so it creates a lot of demand on the analytics front, both in terms of people and in terms of model. And really you have to think that this will become a key priority as we have more REST penetration, as we have a shift towards more continuous time market in Eastern Europe. Also a demand for industrials and from B2B players who want more 24/7 tracking of electricity supply. And so all these trends will reinforce the fact of higher transaction flow, more digitization, and more analytics in these markets. And so now that we reflected on this, what's important is that we see a bit what it means in terms of effect that this could have on the price. So what you can see on the page here is the typical marginal cost of production of the different power capacity in a market. So what you see again is renewable at zero cost, then you start to see, or a marginal one, and then you start to see as well after nuclear, then lignite, then gas, a bit of hydro in between. And this is meant to be illustrated. And so when you see this, then there are basically 5 things that will keep impacting this curve in the future system. Obviously, one is what we're feeling today, which is essentially the volatility on gas, coal, and CO2 prices, which will significantly raise or make the marginal clearing price highly volatile. 2 is obviously the REST intermittency, which is, as we saw, for example, in half 1, 2021 on wind from North Sea, a significant uncertainty level because our ability to limit the effect of prolonged period of low wind is limited at the moment. 3, what we said is, and showed on the previous slide, is the uncertainty around the amount of new build. What we showed is the need for new build in gas and batteries. And obviously, on the gas side, we have some countries which are awaiting clarity in terms of capacity markets or capacity support mechanism or not. And on the battery side, we're also waiting updates around the economics of the batteries and how the ancillary services can be structured around the batteries. So there's still a lot of uncertainty around some of these dispatchable capacity. And you saw the difference between what was announced on gas and what we think will happen, but that gap could change significantly. On 4, this relates to demand. So as we saw earlier, we're moving towards a much more electrified system. And so obviously, it means that the peak load demand will evolve significantly. And so whilst there are a lot of development around smart charging, demand side response, peak shaving, and so forth, to try to manage periods of high load or high demand, still we will be in a system where in days when it's very cold, for example, we will have to manage extremely strained spare capacity in the system. And so that will also play obviously on the clearing price. And building on that point, the last element is, as we have this drop of dispatchable power and we have the uncertainty on renewables, we can face situation of shortage, as we have seen also in the last few weeks and few months. And so that will also lead to more strategic bidding in potentially higher than the last marginal cost of production. And so these strategic bids will also obviously influence what will be the final settlement price on the system. And so when you take all of this into account, we're really moving towards a system which is much, much less predictable, much more uncertain, and it's structurally uncertain. It's not just short-term effect, it is structurally uncertain because of investment decisions, for example. And rolling all this together, what it means and what we see is that essentially never has it been so important to invest in risk analytics, risk management, and essentially to try to see at any point in time, as the markets are moving to real time, what is the risk in the positions on the purchase side, on the sales side, or as a midstreamer, or in between. And that's clearly one of the structural consequences of what we see now. And we think this will be also one of the most critical capability to have for players going forward to continuously invest in sophistication in risk management. So that's a bit what we wanted to share on the European power markets in terms of structural trends and shifts. Happy to take some questions also and get your reaction. And there's also a public report that we published around these trends that we released a few months ago that you can refer to if you want to deep dive a bit on how we presented this analysis. Thank you.
Thank you, Xavier. Great overview. I think touches several interesting topics here. I really wanted to invite everyone to join now the discussion and yeah, put some questions in the Q&A functionality or use the chat if you wish as well. I'm trying to pick it up. So we are sending out the doc. There was initial questions already. If we send out the doc, yes, we share that after the presentation. So the pages we have seen will be distributed. Let me pick up the first questions here. I'm sorry, I need to just jump in. So the first general question is around volatility and price levels we see right now. So you mentioned that already. You see this lasting for longer term because it has these kind of structural components. How this will unfold, how much is temporary right now and how much is there to stay?
Look, we really think it is highly structural. We've entered a new, we're not in a temporary situation. So what we are, when we're engaging with players in the market, what we are telling them is to double down on risk management, on analytics, because that situation that we are showing today, or sorry, that we are living today is a situation we think will be the new norm for the next 10 years, especially as we transition and maybe after 10 years, as we will ramp up more on the battery side and so forth, and there will be more of a steady state or more resilient state that will emerge from the power system. But clearly for the next 10 years, there are too many uncertainty related to investment decisions, to regulatory schemes, to the speed of build out of the renewables and so forth, that will make what we're seeing now carry on.
Yeah. and the volatility and changes do make investments in batteries or in demand-side response attractive. Do you have an idea how much will this dampening effects be? How big can these effects become actually from transport, from batteries on the utility side, etc.? Because we don't see it a lot yet. What kind of extent can we see there in the future?
Yeah, I think it's a very good question. So what we see clearly on the demand side response is an acceleration. So industrials clearly have much higher incentive today than 24 months ago to double down on demand side response with utilities or third-party service provider. And probably that will accelerate further. And that will be one additional element of, let's say, security or dampening a bit the volatility for the system. But it will not be enough. And then the second one is, as you said, on batteries. And I think on batteries, it's much more complex because of the CapEx, the investment decision required, and the uncertainty whether that battery will still be competitive 2, 3, 4, 5 years down the road, unless it's secured a scheme which guarantees the income and therefore the rate of return on that battery project. And I think that's why right now on grid scale batteries or batteries coupled with renewable assets, we're more in a state of wait and see or very slow progress or a few pilots here and there and so forth. And we have been talking about batteries for the last 5 years, roughly. There's still a lot to be done. And so when we look at our model, we do have a ramp up in batteries, but it's much later in the decade. It's more from 2027 in our model that it starts to ramp up more rapidly.
Yeah. What could unleash these kind of investments? I mean, as an economist, you talk about these kind of peak cycles as well. I mean, if profitability is so high, everyone is rushing in and will invest. But do you see there specific regulatory decisions or other events triggering this kind of wave of battery investments? When does it start?
Yes, no, it's a good question because I think on the batteries, sometimes the thinking is a bit similar to a gas plant. So you have countries where people have been waiting to invest in gas plant because there was no capacity tariff. So you can imagine that a capacity tariff, a capacity mechanism that would help de-risk at least part of the investment would be one of the prerequisites. And you see it in different markets where there has been a capacity mechanism or not. For example, on gas, clearly you saw the effect on the level of build out. So that's one thing. And I think for batteries, there's still a lot of uncertainty around this. So that's one. And I think the second one is when it comes to the actual technology, to the level of cost decline, people are not sure whether it's the right moment to build or to wait and see if there will not be a cheaper one to build next year or a better technology on the stationary applications, a solid state or a different setup that would maybe justify why to wait versus rushing ahead now. So there's a bit these two drivers, I think, on the battery side.
Yeah, but we always talk short-term batteries, or is there any part of in your model already considering more longer-term storage?
No, absolutely. It's a very good point because as you may have seen, there has been a report on long-duration energy storage, LDES. And on the LDES side, we do look at the number of options beyond just batteries that look at a storage system or virtual storage system for the grid. And it starts from the next generation of pump hydro to a number of other technologies down to the battery that we know about. And so on these technology, on that spectrum of technology, it's a bit of a similar similar thinking, which is a bit of uncertainty on the technology cost. What's the cost curve evolution outlook? On the technology itself, right chemistry, right component, right module, and so forth, and therefore now or wait or pilot, trial, and see after. So I think that's why we are really at the early stage on this one. And given the development timeline, development lead time, cost decline curve, and so forth, there is a bit of delay in some of this ramping up.
Yeah. All right. So you have discussions a lot with your customers as well on gas power plants right now. So you took a discount there, a significant one, already. What is the usual lifetime of a gas power plant right now? What do you see there in the business cases? how long do they have to be in the market?
Yeah. I think when we look at gas power plant, I mean, let's say I use CCGT as an example, would be, the thinking is around 20 years. And so the question is, what's the terminal value in 20 years? And so if it's zero, because we assume that in 20 years from now, in 2040, we will not need the plant, we need to make the business case work for the next 20 years or maybe the next 15 years. And so the thing is, as any business case that we do, there is a business case, base case, and then there is a down case. And the investor really looks at the spread between the two and whether or not he's willing to take that risk. And the down case can be significantly reduced in a setup where you have capacity mechanism or capacity remuneration scheme. And so that's often, when we look at the business case, one critical element that we look into. Obviously, you can also take a view that the base case can still give you an attractive return if you anticipate dispatch shortages, if you anticipate high volatility and therefore high value of the gas power plant on the ancillary services side or on the intraday markets, and therefore build a business case around it. But you have a significant downside risk scenario, which often investors want to mitigate. And you can make that work and not necessarily need at the end an additional resale value in 15, 20 years from now. So that's really how we look at it today.
Very interesting. I mean, you looked more on the short-term markets right now, and the complexity of data or influencing factors. You have shown your 1 to 5 there. I mean, just to mention, there's as well geopolitics in a way, which affects through gas markets, etc., as well, the prices. Risk management becomes more and more important. You're talking to different kind of companies. Is everyone willing and ready to upgrade its own skills and technical setup, capacities, etc., to deal with this kind of complexity, or how will this influence the structure on the market?
Yeah, I think clearly at the moment there's a full spectrum of players when it comes to risk management. I think when you look at the type of risk that people are looking to capture, model, evaluate, and so forth, we're talking about cannibalization risk. We're talking about shape risk. We're talking about obviously all we have on the price risk side, on volume output, which is more of a midterm level. And then this adds on top of credit risk and so forth. I mean, we have seen the press over the last few weeks, few months, and credit risk is also becoming increasingly important, especially as it more and more correlated to market risk, because in extreme price volatility situation, it leads to extreme margin call requirements, and then it leads to much higher credit profile from some of the counterparty out there. So when you take all this into account, which is those new type of risks that were not necessarily in the models before, and this additional linkage between credit and market risk, it's clear that a number of players need to upgrade and make more investment in sophisticating their risk model. That's a clear view that we have on the market now, and we see a number of players making these investments, and it translates into much more sophistication on the model, much more computing power dedicated to the simulation of the power market and what it means in terms of price and what it means in terms of volume and what it means in terms of risk on the positions of the company. And then it means also more people dedicated to it, because it's not something that you just press a button and get a result of. There's a lot about interpretation, understanding the so what does it mean, and building specific custom scenario. So clearly it's an area that requires more modeling and analytics tools and more people and talent for the interpretation and building the intelligence on it. It's clearly something that is being strengthened as we speak.
I mean, we've seen as well, to add on that, quite some market participants which were relying very much on the short-term markets, to balance their needs and which are maybe not equipped actually to be exposed to these kind of risks with the current setup. So on the longer term view of the markets, you see as well, triggered by the high level of prices right now, a rush towards the PPAs in the market, where especially industrials, try to secure their share of green energy in a way. How will this affect this kind of shifting volumes and trading to PPAs? Does that have a long-lasting effect on the markets you see?
Yes,
because it withdraws as well some volumes of the wholesale market.
Yeah, you're absolutely right. So clearly, what's interesting is that I think maybe 2 years ago and before, industrials were more looking at on a contracting profile on a 1 to 3, 4 years horizon. And I'm talking about mid-size industrials to large-size industrials. And what we saw is that the corporate PPA wave, when it started about, I would say, 3 to 5 years ago in Europe, a lot of it was the focus from the very large corporates. And it was also a focus for a small share of their portfolio. And what we have seen over the last, I would say, 12 to 18 is not only a willingness from corporates to go with a much higher share of the portfolio on PPA, but also, and that was quite new, the mid-sized industrials, the SMEs, and so forth, go either on a standalone basis or sometimes in pool of SMEs, going to contract PPAs for 7 to 15 years. And so clearly, right now, when players look at what's happening on the energy market, you can see that reaction that is triggering a need to secure power on a more longer term basis. I think the other element to factor in is, you know, for a number of industrials, not the energy intensive one, power is a cost, obviously, but out of everything that they buy to make their product, it was not necessarily the biggest cost, but suddenly that cost has been sometimes multiplied by 3, by 4. And so their share of that cost in their total budget now is not something that used to be in the second or third category. Sometimes it's moving one category up. And so it triggers also much more attention from the management teams who say, well, what do we do about it? Now, suddenly something that used to be more our element number 10 on our purchasing categories is now moving to item number 4, item number 3. And that's why we also see this as a motivation for taking more PPAs. Now, I think on the PPA side, there's still a lot that needs to be developed in the market in terms of making the right products. Ideally, the customer would like a PPA, which is an as-consumed PPA. But then you have a whole lot of spectrum between the as-consumed 24/7 PPA and the pay-as-produced PPA. So I think that's where we see a lot of room for innovation, more structured product, or something a bit more bespoke built so that it can fit the need of the different customers or industries. And then I think finally, one element of interest is obviously in the PPAs is the ability to have, as you said, a fixed supply for the coming years, and therefore it may remove a bit of volume from the market. And so that will be one thing to watch out, what it has in terms of impact on liquidity. I think we have not yet really seen, it's very marginal, and we have to see, because it may also trigger additional needs for one party or the other to hedge. So on the forward market side, maybe it will create some activity. You have index-based PPA and you have fixed-price PPA, so the hedging will be different, and it may trigger also some activity on the paper market. So let's see what it triggers.
But being a little bit provocative, I mean, you described that the power markets get more complex, more risky in all aspects. And then you have companies now rushing in who don't consider this their core business, being exposed to these risks and taking some of these risks basically on their balance sheet. Is that something where you would, how you deal with this when you're talking to your clients?
You mean the question would be that as you take these long-term supply or sale position from a PPA, the effect it has on your balance sheet, your disclosure, and so forth?
Yeah, you're taking on non-core business risks, basically, as a company, power market risks, maybe merchant risk or everything, which are actually not your core business in this situation. And the markets do get more complex. I mean, all the, let's say, professionals are struggling with it. And now you see companies coming into this market through PPAs, taking on these risks. This is what strikes me at somehow, I don't know, I don't can make sense out of that very often.
No, absolutely. And I think I think the PPA is at the intersection of different needs for a client. So we talked about the economic need, more volatile price, higher prices, ability to secure the price and the volume. But I think it also comes with the decarbonization agenda and the green agenda. And so the rationale also to go into these contracts is a bit an equivalent of making a long-term investment into greening part of the emissions that are embedded in what industrials do or produce, or services company do. And so it's true that ultimately it means taking a long-term position in a market that is non-core to what you're doing. And it means that it will be shown as part of all the long-term commitment that the company is making on their accounting disclosures, on their overall corporate. That's absolutely true. And I think players see it as a need to fulfill both decarbonization agenda and economics resilience agenda, and are willing to basically make that trade-off.
Yeah. Leads me to one question, maybe a difficult one. I mean, in your model, you're basically matching demand and supply as we know it for power and build it up. If we would just focus on green power, how would you see the development there of the demand side? So how much elasticity we have on the green side if we only match the renewable production of power with demand for purely green energy? Can you predict that? Will we see a significant different price for green power than for, let's say, gray power?
Well, I think ultimately it will translate a bit in the price we will assign to the guarantees of origins or the EACs or the GOs. So I think right now that's a market that has been relatively on a low price point. And it has not, you haven't yet seen a very strong increase in the price of the certificates that highlights the much more differential between gray, or let's call it non-green and green. And I think indeed that could be changing over time because of the scope 3, scope 2, scope 1 implication of clients reporting emissions. So as clients look at more and more neutralizing the emissions from what they purchase on the electricity side, then, or some of the emissions that they produce directly on their site for large industrials who have CHPs, for example, and so forth. The ability to green this is quite important. And so the ability to green the associated supply of electricity or the on-site production will be key. And so as we see that, then definitely as we see carbon prices moving up, and as we see the requirements for players, even for the ones who are not subject to carbon liability, still wanted to invest in greening their portfolio, and a very strong demand for either securing the supply physically or buying the certificates to cover part of that, either on the GO side, the EAC side in other countries, and for sure that demand will be extremely strong, resilient. Now, it's very hard to say what will be the consequence on the absolute price of the GO EAC, because it's a whole supply and demand balance analysis that is required.
And maybe we have some structural changes as well, as some people are not happy with the, let's say, the construct of GOs, just to green the energy.
It could be
24/7 ideas. Yeah, absolutely. We get regularly questions around the build out of solar energy. I mean, there is some, it's very hard to predict, let's say it like that. We had this several times. How are you dealing with this? There are different kind of factors. Do you think what we have seen is more on the positive side, maybe as well wishful thinking, or is this what you realistically see really happening now? This,
Yeah, no, I think in our model, we take into account the amount of eligible land We do take into account the time it requires for permitting, for grid connection, and so forth. So we take into account the realistic constraint that you could anticipate. But I would say it's a base scenario. And what I wanted to highlight is that there could be also headwind to that scenario, because we know when we go in specific regions, cities, or locations for a specific wind project or specific solar project, that actually the time it takes to do the community consultation, the public consultation, the oppositions that there can be in certain regions and so forth, does add quite a bit of delay. And when you aggregate those discrete events and you roll them back up, it can provide a bit of a delay on what is our base scenario. Now, we try to take some of this into account, there's a bit of a contingency, but I think there is probably a scenario on top that is a more conservative one that would reflect a bit more delays in getting this happen. Now, there's also a whole education process as well around the acceptance of having the renewables in certain areas, in certain locations, and so forth. So this may evolve, but I think we should not underestimate the fact that additional delays could come into the picture and delay a bit the forecast that I shared.
And the reaction would be, let's say, the classical power plants being longer as well active, or
that could be one. Or it could be maybe a rebalancing. It could be maybe acceleration on offshore, a bit less on onshore, depending also a bit if some regions develop more than others. It could be maybe more imports from a region to another than just organic built out in the different regions. So I think it could be leading to a bit of rebalancing. In terms of the location, in terms of the technology split. That could be one of the consequences.
Excellent. We still have some time for some questions. I'm just inviting everyone to join in with some more. Let me pick up some more questions we have already here. We talked about the PPAs. There's a question around the baseload PPAs or virtual baseload PPAs in a way as a product offering. Could that help advancing the market in this way, what we discussed?
Yes, I think it's already happening. So yeah. I think so. I think when you look on the PPA side, you have a full spectrum of solutions. So again, you have the physical pay-as-produced PPA, you have the virtual pay-as-produced PPA, you have PPA from single project, from aggregate of projects. You have some PPAs which are a mix of solar and wind, which give you a different profile. You have some which can be coupled with hydro, which could be then giving you a specific shape, and then go more into specific full green base load or even as consumed profile. So you can engineer a lot of different PPAs. I think we know from announcements that are being signed, that are coming regularly on the market, that we see those more, I would say, exotic structure or advanced structure being developed. Not everyone can do this, because it requires a big portfolio, it requires a big trading business unit and risk management capability to structure these products and then to manage these products within the portfolios. But clearly, as the premium between the plain vanilla PPA and the more advanced PPA maybe compresses a bit, then it will become more and more attractive for a number of industrials or large PPA buyers, that's for sure.
Absolutely, great. Then we get some more questions around capacity markets. Especially, we have a question here around, I'm not an expert, around the French market. There is something at the horizon. Can you share your view on that?
I don't know. I think I don't know on the regulation side if things will evolve. I think in general, when you see capacity markets, if you look at the ones who have been established in the past, if you take Italy as a country, for example, it has been effective in securing investment. But then I think at the end, it's really down to each and every single regulator to see what scheme is required to incentivize one specific technology or specific capacity built out as a whole of dispatchable power. There are multiple ways to do so. you can guarantee a contract for difference for a large new dispatchable power investment. And so essentially what you're telling that investor is that for the amount of power that will be produced, if the prices drop at one point, we do a contract for difference and I will pay for the delta. Yeah. Another way is just to remunerate the capacity mechanism. Another way is to have a specific ancillary service that maybe if the plant is under use, it can always go into that service and you guarantee some access to it. So I think there's a whole spectrum of ways that can, or levers, sorry, that can be used to incentivize dispatchable power investment. I think we know from our model and from what we shared that dispatchable power is shrinking and we need to invest in it. And there are not too many options, at least on the medium term, I would say. And so what we will see is a lot of evolution of existing scheme or new scheme in European countries. That clearly will happen. But again, it may take different shape. I think it's down to every country also to see how they structure it.
Yeah. Maybe a last question to conclude, and it's as well a very much discussed topic is hydrogen. You have now hydrogen as part of your predictions in there, clearly visible, a significant demand side aspect. Do you see it as a just can hydrogen compete from your view with electrification, or how do you see this playing out? Is it mostly driven by the subsidies going or flowing into this area, or you really believe in the hydrogen economy?
So look, I think from a hydrogen perspective, so we do publish a lot on hydrogen and so forth. So we do have a forecast for hydrogen outlook, whether it's blue or green. And I think when you look at the hydrogen story so far, there has been a number of commitments, number of project announcements. Yeah. Obviously, when you go in terms of number of build or existing in production project, we're at a much more smaller fraction of this. And so I think to answer your question is probably a bit difficult. It would require a whole separate discussion. But the way we look at it is that there is a significant cost decline on the electrolyzer side that will make the economics work, but only for some application at the beginning. And it's more, for example, in some of industrial application, in steel and fertilizer, and some of the gas-intensive application or hydrogen-intensive application. And then also from some mobility, more on the heavy transport side. And then as the cost decline goes further, then you will see probably adoption in other adjacent sector. So when you put that into perspective of the announced capacity built out, there is a scenario where that matches. So essentially, a growing number of applications where it provides a suitable alternative to the current energy feedstock or energy input. And compared to that, when you look at the supply growth, then that's a scenario that is roughly in balance. But I think, again, a lot remains to be done on hydrogen. We're at very early stage, so hard to say too much more now.
Yeah, there's quite some speculation. It stays interesting. We will have another episode on that, I'm sure, to discuss that. For today, Xavier, thanks a lot for joining us. It was really interesting to having you again. And yeah, thanks for sharing your perspectives. Thanks, everyone, for participating. Again, we had some good questions here. Hope to see you all soon again, here or in person. And thanks, everyone. Have a good afternoon. Bye-bye.
Thank you very much, Jens, and bye-bye, everyone.
Bye-bye.